So thank you everyone for tuning in to our presentation today. We have two great speakers. We're going to share stories, insights, and practical knowledge about tax planning for sellers. My name is Patrick Gardner, and I am a real estate broker and loan officer with Guarantee Mortgage and Vice Chair of the Education and Events Committee at SFAR. On behalf of the committee, I would like to welcome you to our Zoom call today. As we get started with the webinar, I want to share some logistics for our meeting today. All Zoom audience viewers are on mute throughout the entirety of the presentation. The webinar is being recorded and will be available to view on Monday in the SFAR social video library. Please ask questions through the Q&A box located at the bottom of your screen marked Q&A. We will not be monitoring the chat feature throughout the presentation, but will be answering the questions asked through the Q&A box at the end of the presentation. If your question is not answered to the degree that you would like, please feel free to reach out directly to the presenters with the contact information listed on the Q&A page at the end of the presentation. As a chairperson of a SFAR committee, it is my pleasure to introduce speakers for these events. But it's also my responsibility today to share that I have personal and business relationships with both of our presenters. I work with them closely organizing events, refer clients to them, and close business together. I'd just like to be upfront with that as we get started. Our speakers today will be presenting on tax matters relevant to the sale of real property. With the unique economic and social circumstances related to the pandemic, it is critical for sellers to have the flexibility and creativity of forward tax planning. Our presenters will touch on a variety of topics from tax exclusion to favorable tax provisions in the code, and then finally on to tax deferral with liquidity and where that's offered. They'll provide insight on tax planning strategies for primary homes, income, and commercial property sales. As we all know, capital gains in California can cut up to a third or more of the profit a seller hopes to receive on their sale. Taxes can literally drain the motivation of an eager seller who wants to sell, but also wants to maintain their position of wealth. Fortunately for us, on the tax side of things, the filing deadline from the IRS has been extended for both 1031 exchanges and for federal tax filings through July 15th, 2020. So there is still time to plan and to assist your clients in their tax planning strategies. Our tax attorney for today's discussion, Raul Escatel, is a senior partner at Ascendant Law Group, LLP, and he focuses his practice on advising individuals and businesses on a wide range of international, federal, state, and local tax issues. With over 12 years of experience as a government tax lawyer, Raul has particular expertise in the successful resolution of tax disputes at the federal, state, and local levels. Raul is certified tax specialist by the State Bar of California and has a master's in taxation law. He is licensed to practice in California and before the U.S. Tax Court. Our other speaker joining us today is Jon Vicars. He is a 40-year veteran broker for commercial real estate. He's owned and operated Spirit Venice Commercial Brokerage in the East Bay, and since 2008, Jon has been the vice president of Escrow Collateral Corp, a qualified intermediary and specialist in the monetizing installment sale. Jon is past and current president of the Berkeley Property Owners Association, broker member of OBAR, CAR, and NAR, member of CCIM, and a Berkeley Rotarian. His commercial and investment property expertise comes from ownership, sales, and management of multifamily and retail properties since 1980. He is currently the majority owner and manager of a number of apartment buildings and multi-tenant retail properties in the Bay Area. Both of the speakers have made their living by working within and adapting to the tax code, particularly as it pertains to sellers and their tax planning. Each of them brings deep experience in their specific field. Raul, a former tax attorney on the government side, he knows what the Franchise Tax Board and the IRS are looking for and how to keep your clients out of audits. Jon's experience with exchanges, installment sales, and investment in commercial properties over the last 40 years gives him insight into what sellers are thinking and the actions they are likely to take during the life cycle of their property ownership. Please take this opportunity to learn from their dealings and help your sellers make thoughtful decisions around their tax matters. Jon, would you please start us off today?
Sure. Click it forward, please. Next slide. Next slide. Next slide. Next slide. There we go. Oh, that's fine. Well, welcome everybody. So I was talking to my tax accountant a couple of weeks ago, and he just reminded me how complex the tax code really is. So I looked it up. The Tax Foundation says if you include the tax code, the tax law, the tax examples, etc., you exceed 74,000 pages of material. Now that's way more than anybody can think of. Fortunately for sellers who are considering selling their real estate, there's only a handful of tax codes that really sellers look to solve their tax problem. And the problem is pretty basic. Many sellers either don't want to pay or they can't afford to pay the high capital gains tax we have here in California, which prevents their sale. So it's helpful to get an overview of those tax section codes. And to do that, I'm going to pass it over to Raul, our tax attorney here, to highlight those. Raul?
Thank you, John. Good morning, everybody. Yes, John, that is correct. There are over 74,000 pages in the Internal Revenue Code and the accompanying regulations. But I'll tell you this, if you ever have a difficult time going to sleep, that'll knock you out in an instant. So as Patrick mentioned earlier, I've been a tax lawyer for now almost 20 years, over 12 of them in the government. And one thing that John talked about, the problem. So it's a problem that I see a lot with my clients. It's basically, how can I minimize the tax when I'm going to sell, in this case, let's talk real property, and keep more of the proceeds in my pocket. So what we're going to do today is provide you a broad overview of the tax issues that come up with the sale of real estate and how little things you can do, just being aware of them, can help you minimize the taxes on the sale and keep more money in your pocket. So with that, can we go to the next slide, please? So as many of you are aware, the sale of real estate produces what's called capital gains. So what is capital gains? And everyone knows it's just basically the profits earned when a capital asset is sold. It's the difference between what the seller paid for the asset and what they're selling it for. So just to kind of go over the foundation, so let's talk about what a capital asset is. It's pretty much all property held for investment. Examples include real estate, commercial real estate, personal residence, stocks, even artwork and collectibles. Pretty much, it's easier to understand what a capital asset is by what a capital asset isn't. So the exceptions to a capital asset are basically inventory and accounts receivable. So now that we know what a capital asset is and capital gains, let's see how it's going to be taxed. Next slide, please. So these are what you're looking at here are the taxes that apply to the sale of real property. As many of you know, the capital gains tax, the tax imposed on the percentage of the profits. Currently, the top rate for capital gains is 20%. And we also have the net income tax, which is imposed at a rate of 3.8% on investment income. And not to be left behind, we have California, since we live in California, and where the top rate here is 13.3%. So what you're looking at here, if you're just without any kind of planning whatsoever, a seller is looking at paying 37% of taxes, of capital gains taxes on the profits from the sale of their asset. Oh, and it gets better. California, not to be, well, this was in California's fault, but up until 2026, sellers are not allowed to take a deduction for state and local taxes. So that's also another consideration that when I speak to my clients that needs to be brought up. So 37%, what does this look like? If you go to the next slide, just to kind of give you an idea visually what that really means is, so let's take a simple example of someone selling a piece of commercial real estate. They have $4 million in capital gains. What are they going to end up with? Let's see, 20% in capital gains. And after all the taxes, the capital gains tax, the state tax, and then the net investment tax, a total tax of almost $1.5 million. Think about that. That's why you put it in red, because that is a lot of tax. But with a little bit of planning and a little help from the code, we can actually mitigate that. So let's go to the next slide, please. So the tax code, is it really our enemy or can it be our friend? So there are actually taxpayer-friendly provisions in the code that some of you may or may not be aware of, and that's kind of what we're here to talk about. So we have, they're generally divided into three categories. We have the exclusion exemption provisions, which basically allows a taxpayer to exclude some or all income from taxation. The ones that many of you may be familiar with are first, the Section 121 exclusion on the sale of a primary residence, where an individual can exclude $250,000, where a married couple can exclude $500,000 from the gain on the sale of their residence. We have a Section 1014 basis step up at death, which basically is a readjustment of real estate that reflects a fair market value rather than the value at which the asset was originally purchased. A simple example is, let's say we have a child who inherits a home from mother, originally purchased for $100,000 in 1990. This is not the Bay Area. At the time of the mother's death, the home is worth $200,000. If son decides to sell the house for, let's say, $300,000, son will only be taxed on the difference between the fair market value at the time of inheritance, $200,000, and the amount that son sold it for. So for only recognizing $100,000. So those are the exemption and exclusion provisions. There are others, but we want to focus on more to real estate. The next category we have are deductions, which the deduction provisions reduce a portion of a taxpayer's income from taxation. And as it pertains to the sale of real estate, we have expenses upon the sale, incurred on the sale of the property or the transfer of real estate. Here we have cost of repairs and improvements related to the sale. We have fees from real estate agents and people like me, attorneys, we have title insurance, cost of advertising, escrow fees. I think you all are aware of the expenses that come with this. And so that is our second one. And our third one, and the focus of this presentation today, are the tax deferral provisions. Next slide, please. And what these do is they postpone, their purpose is to postpone a tax. There was this article that I read recently in preparation for this presentation. It was an old one. It was about Warren Buffett that basically said that he became the world's most successful investor by understanding how to put off tax payments and build his wealth. Put off tax payments. That is exactly what tax deferral is in a nutshell. And there are three provisions that we're going to be speaking about today, two of them briefly and one of them more in depth. Next slide, please. We have 1031 exchanges. Next, qualified opportunity, investing in qualified opportunity zones, and installment sales. So these all are very common deferral provisions involved in the sale of real estate. Can we go to the next slide, please? So we're going to just go really basic on the 1031 exchange, basically a property swap. And the requirements are there must be an exchange, the property must be of like kind. After the 2017 Tax Cuts and Jobs Act, like kind specifically refers to real property. So now 1031s can only be conducted between real property for real property. And that the property must be held for business use or investment. One thing that I want to focus on here is the qualified intermediary, the accommodator that's used in the 1031 exchange. As John's going to speak about later, it's important to understand what this concept is, because the QI, in this case, qualified intermediary, is what allows a 1031, a 1031 transaction, the deferral provisions within the code, and it goes in the depth of the regulations. But it's important to understand that the QI is a big key here in terms of allowing that deferral a benefit under Section 1031 of the code. So 1031, I mean, working for the government and franchise tax board, I was actually on what's called a 1031 task force. We went after 1031s all the time. I always tell my clients, yes, the IRS is scary, but the franchise tax board is even scarier. They're very smart and very aggressive. And we would always nitpick the requirements here. One of the timing requirements, the 45-day identification letter. There was one example, I remember that we actually, the identification letter was submitted 2 hours after the midnight deadline, and that was enough to disqualify the transaction. So the thing about 1031 transactions, they must be followed to the T. So with that, let's go to the next one. We're going to talk a little bit about, not too much, but there's a provision that was also enacted under the Tax Cuts and Jobs Act that refers to investing in qualified opportunity zones. And so qualified opportunity zones are basically economically distressed areas that investors can invest in. The point of this was to use underutilized dollars, in this case capital gain, to be put to work in areas that need long-term investments and spur development, and that may have low economic mobility, high poverty numbers, and loss of jobs over time. The map that shows all the qualified opportunity zones was made in 2012. And as many of you know, that was when the worst of the recession. And so what's interesting about looking at some of these, what constitutes a qualified opportunity zone, is that a lot of them are in places like San Francisco, New York. And in fact, I live in Oakland, and about 80% of Oakland is a qualified opportunity zone. There's a great article, if you are interested in about seeing who's benefiting from this or not. It's in the New York Times. It's in 2019, and it goes into depth about how these qualified opportunity zones work. And the reason I bring that up is because the policy behind this was to invest in areas that needed economic development, that needed an economic spark to get them going. And you know, in that article, there was talking about like building high-rise luxury condos, a Ritz-Carlton in New York. There was a fancy pet hotel, I think in Southern California. So the funny thing is that the people that are benefiting from this are actually real estate developers. And I'll go a little bit about what the benefits are in the next slide, please. So basically, the slides can be, the benefits can be summarized into three things. The capital gains are deferred. So basically, what qualifies for the benefits under the zone regulations is capital gains that are invested in a qualified opportunity zone can be deferred until 2027, or when the investment is sold, whichever occurs first. There's a second one that is basically a 10% of forgiveness of the capital gain payment, which is called a step up in basis, if the investment is held for at least 5 years. And the third one is if the investor holds his or her investment in a fund that invests in a qualified opportunity zone, that any gains thereafter will be completely excluded from gross income. So if the initial investment is $1 million, it's held for 5 years, then at 2027, the taxpayer will pay the capital gains on that $1 million that was deferred, but pay only $900,000. And if the taxpayer holds the investment for over 10 years and that investment doubles in value to $2 million, the $1 million in appreciation will be completely tax-free. So it's a pretty good benefit. And you know, the cynic in me is like, when I first heard about this, is like, oh, this is a bonanza for real estate developers and people that are in real estate, and it has come to be. It'll be interesting what happens now with COVID-19 and what's happening in urban areas now. But that's a qualified opportunity zone benefits. Oh, and one thing Patrick mentioned earlier, that there is also an extension for 1031. There's also an extension of time to invest in qualified opportunity zones. They also have a 180-day period, and it's been extended. So, I've been giving many presentations on these zones, and I've actually formed funds for clients. If you want more information, please contact me. It's very technical, and this takes up a good hour by itself. So I just wanted to give you an overview of it. And so let's go with that. Let's go to the next slide. So now we're going to talk about the heart of this presentation, which are installment sales. So what are installment sales? Installment sales are basically IOUs. And so an installment sale allows the taxpayer to do is to basically recognize income, not upon when the asset is sold, but upon every time that the seller receives a payment. So it kind of basically delays the payment of tax based on how the installment sale contract is set up. If it's a 10-year installment contract, then the gain will be dispersed over 10 years. We're not going to go over the calculations, how to calculate installment payments, because it's very technical, and we want this to be an overview of the various provisions in the code that assist taxpayers. And so, can we go to the next slide, please? So the benefit here is, like I said, tax is paid over time on the principal received. But there are also downsides to this too. One of the things, because of seller financing, the seller must monitor the payment streams. And this might be a hassle for some sellers because they have to basically police the transaction. And also the liquidity, unlike a straight sale where the seller receives the entire proceeds of the sale, in an installment sale, liquidity is limited to the installment payments received. And also from just a tax reporting perspective, having to fill out the form to report installment payments every year can be a little bit of a hassle as well. So with that, can we go to the next slide, please? Let's talk a little bit about the installment sale. So the installment sale is found in Internal Revenue Code 453 and the regulations. And what John's going to talk about is basically the evolution of the installment sale, which is referred to as a monetized installment sale. And this resulted that in the 1980s, because of the high interest rates that basically brought the financial institutions, lending departments to its standstill. Part of what Congress's response was to codify what is now known as a monetized installment sale into the code. Congress saw installment sales as a potentially substantial contribution to economic recovery because a seller could, for example, carry the paper on a sale, and a particular buyer who needed financing be able to pay and could agree on interest rates that they might choose, regardless of what the market interest rates were at the time. And to encourage sellers to be willing to carry the paper, Congress added provisions which allowed sellers to sell on an installment contract for a deferral and also receive borrowed money at the same time without losing any of the benefits. So, and John's going to talk a little bit more about that because he's got experience with this. And one of the things, so like in the slide, it shows that the monetized installment sale was actually a necessity at that time because it provided liquidity and deferral. And with that, we're going to turn it over to John, who's going to go into depth about what a monetized installment sale is and its benefits and so forth. So John, take it away.
Okay, next slide. So the monetizing installment sale is actually simple. Next slide. The monetizing installment sale is just the traditional installment sale that Raul just overviewed there, plus combining it with an independent third-party loan so that the installment sale pays off the loan. What you get out of it are basically three things. Next slide. Tax deferral from the installment sale. Next slide. Cash for investments. Cash, this is non-taxable cash that you can invest however you choose, whenever you want to choose, whenever you want to do it. And the administration on these two loans is simple with automatic loan processing. Next slide. So the easiest way to understand how this works is to go through an example. This is one I put up earlier on the screen. This is a couple who had owned their property for 25 plus years. And they were getting tired of the management, the toilets, the tenants, the trash, and also the mounting regulation by both state and federal governments. Rent control is one. They decided to sell. The problem is, if they just sold the property for cash, they would have paid a huge tax we figured it was about 6.5 years worth of price appreciation. So that wasn't going to work. So they opted to do a monetizing installment sale. Next slide. And this is how it works. So there are essentially 4 participants, 4 unrelated parties in a monetizing installment sale. Next slide. There's the seller. Next slide. There's the buyer. There's the dealer. The dealer is an intermediate buyer, a qualified intermediary that Raul spoke to earlier. And then finally, an independent third-party lender. So let's walk through the transaction and see how it works. Next slide. So the seller goes out in a traditional way to find a buyer, hires a real estate broker, but at the close of escrow, next slide, instead of selling the property directly to the buyer and being taxed, they sell it to the intermediate buyer, a dealer. In this case was our company. Next slide. And just like as in an exchange, the dealer bought the property, our company bought the property from the seller, but on an installment sale basis. They promised to pay to the seller over a 30-year period, interest-only payments at about 6%, and a personal guarantee. Well, simultaneously, which happens in a nanosecond, again, just like an exchange. Next slide. The company sells the property to the buyer for cash. The deed goes around the buyer, or around the dealer to the buyer to maintain the guarantees and representations of the contract. So at this point, the buyer's happy. They've got their property free and clear, and they're ready to go off and do what they're going to do with the property. Next slide. Now, the cash from that resale didn't go to the company immediately. It was put into escrow pending this second transaction. Now, the seller, if they choose to get liquidity, they can get a loan. They can get a loan with a lender who our company has a credit relationship with. Next slide. A loan, next slide, that is essentially the same, with the same terms as the installment sale the seller has with the dealer. So the lender lent to the seller a 30-year loan, interest-only payments that match the installment sale payments. And one final provision, which is key, is limited liability for repayment. What that means is that if the dealer goes out of business over 30 years, the lender can only look to the dealer for repayment, providing that the seller maintain the automatic loan processing system. And they'd want to do that anyway because there's no check writing. It's simple. It costs $300 a year. There's no reason for them to change that. So what happens here, next slide. So what's happening here is now the seller has 2 loans. They have an installment sale loan that was given by the dealer that makes payments. Next slide. To the seller. Next slide. And the seller then makes payments to the lender. That's a wash. Next slide. So the end result is the monetizing installment sale gave to the sellers. Next slide. 30 years of tax deferral because that's how long there was interest-only payments. That's from the installment sale. Next slide. Non-taxable cash from the loan proceeds that they can invest however they choose. They could invest in not only in real estate, they can invest in stocks and bonds, they could pay off debt, whatever they choose. And the administration is straightforward and fairly simple. Next slide. So the costs of the monetizing installment sale are essentially the lender's cost. The buyer doesn't take, or the dealer doesn't take a fee, or a company doesn't, because they're buyers. And I've never in my career have ever seen a buyer getting paid to buy a property. It's really the lender's cost, and the effective lender's costs are the equity cushion, because the lender lends 95% of the value of the installment sale note, and plus their loan origination fee, and so the total is about 6.7% of the installment sale amount. One thing I might add, though, if we go back to that previous slide, could you go back just a second? So at the end of the 30-year period, the dealer will pay the seller their principal payment, and then the seller pays the lender. But at that time, they're receiving their principal, so the seller may owe a tax. Now, over 30 years, a lot of things could change. First of all, the seller could have a loss along the way. They could offset it with this gain. That's why people defer taxes. Inflation is a terrific friend, because at the end of 30 years, the dollar will not be worth the dollar today. If you just use the Federal Reserve's target rate at 2%, it'll be worth 50 cents on the dollar. But considering what's going on in the world today, I think 2% is probably mild. It should be worth less. So inflation is your friend. And of course, tax rates could change too. Okay, next slide. Let's go on to the next slide. So let's see what happened to our sellers here, our couple. So if they just sold the property for cash, they would have ended up, after paying tax, of about $2.5 million. But after the monetizing installment sale, they ended up with over $3.6 million, a dramatic difference. Next slide. The other example I put up, an owner had bought a number of single-family homes in the Marin County area and had over-leveraged them, gotten as much loan as possibly on the buildings. And at that point, they turned out to be alligators, because he had to feed the buildings every month just to pay all the expenses and maintenance, because the rents didn't cover it. He wanted to sell the property, but next slide. The problem is, if he just took cash and paid the tax, he'd have to pay out himself $100,000 just to sell his house. So he opted to do a monetizing installment sale. Next slide, please. And rather paying out $100,000, by deferring the tax, he ended up with over $300,000, a much better position to be in. One last example of this, which I think we can all kind of relate to. Next slide, please. So partners in property, partners like a marriage. Well, you know, people all go different ways, and we all know how that works. In this case, that's true. There were five partners who owned this building, and they owned this in a limited liability company, which means that they own shares in the limited liability company, which owned this property. But none of them could agree on anything. They couldn't even agree on what color paint to paint the building on. Two partners wanted to fix the building up, re-tenant it, and then maybe trade it, sell it and trade it. The other three were just happy with cash flow, or they would be bought out. But if they would be bought out, they didn't want to pay the capital gains tax. So, next slide. So we had a basic partnership disagreement, pretty common. So the way to solve this is they used a monetizing installment sale. Next slide. And what they were able to do with this is the two partners who wanted to hold on to the property bought the other three partners out using the monetizing installment sale. So they got cash, and each one got their own individual installment sale. So they got their tax deferral and their separate cash. They go out and do what they want to do. So in effect, the monetizing installment sale just separated and partitioned everyone's interest, so they got what they want. The next slide, please. So I get questions about this, and just not to go back too much in what Raul has mentioned about but the history I think is interesting. So In 1913, which is when the code began, is when they put section 453 for installment sales in the code. So it's been around a long time. But the most interesting one, next slide, is the codification of this in 1980. Now, Raul had mentioned that the reason for this is because money was tight in 1980. Banks were not lending. And I know this for a fact because my first property that I sold as an agent was a single family home, a rental home, and we sold it to a couple. We helped them get a loan from California Federal Savings Loan, the best single family home loan we could find, 30 years interest, in 30 years amortization at 12.5% interest. That's right, 12.5% interest. I don't know what it is today. It's maybe in the close to 4% or 3%. Patrick would know. Well, Congress realized that one of the ways to stimulate the economy was to encourage seller financing. And if the seller wanted liquidity, they could go out and get a loan simultaneously, providing they didn't collateralize that loan with the installment sale. They could continue on with tax deferral. And next slide. And there are a lot of institutional sales which are beyond the scope of this talk today, but they're in the millions of dollars. I know one that's $1 billion. In fact, the Chief Counsel wrote a memorandum on one of them in 2012. It's an interesting history. Next slide. A question I get often asked is, what is the difference between the monetizing installment sale and the 1031 exchange? Next slide. So the exchange is really a very valuable tool for seller owners who want to grow their portfolio. And it's because they can use the total amount of their net proceeds from the sale to invest in a new property versus the after-tax proceeds of the sale. And I know this has worked well for a lot. In fact, I know a guy who started off with a duplex and successfully traded up, refinanced, did this over years. Today, he owns over 350 units in the Contra Costa County area. Next slide. The 1031 exchange, as Raul has pointed out, has some very tight rules for the exchange. It's the 45 days to target, 180 days to close. It's also the kind of property. Next slide. You can only transfer, you can only use a commercial property, now investment property for investment property. Well, none of that applies for a monetizing installment sale because, first of all, they have no rules for timing. You can take the cash, put it in your bank account, and just wait for the opportunity to buy something, which is a real advantage, I think, in today's market, too, because if a seller knows that you are in an exchange, they're not going to be bashful about asking for the highest price and giving no terms. You have no negotiating leverage, particularly if they know that the seller or the buyer has to buy something with 45 days, otherwise they're going to get whacked by a capital gains tax. And the assets that you can buy with the monetizing loan funds are really the seller's choice. So I say it could be more real estate, in which case you get a step up in basis. You get a new cost basis to start depreciation from. You also get you could also do stocks or bonds, pay off debt, which I think is going to be a big one here. I was contacted last week by a small company who owns property, who are interested in, and they have been under this lockdown thing, and they're wondering how to get out of it. They're going to need money. And the banks are a little squeamish now about lending to small businesses. So they're looking into possibly a sale leaseback of the property where they would sell their manufacturing, it's a big warehouse essentially, to an investor for cash. But they're interested in doing a monetizing installment sale so they have all the cash to go and invest into their company. It's called a sale leaseback. So we'll see that going on. Next slide, please. So I mentioned the cash advantage. It's good to have cash. Cash is an advantage to have, and particularly in negotiations. Now, last slide. Estate planning. So the benefit of a 1031 exchange is you're not out of property. You're always in property. So if you pass and pass that to your heirs, you get that step up in basis provision. There's an old adage in the exchange world that you trade, then you die. Well, sounds a little macabre, but nonetheless, you get the idea. Now, the installment sale, though, is a sale. It's happened. There could be a tax at the end of 30 years. But as I mentioned, over 30 years, with some sort of basic financial planning and tax loss harvesting, you might be able to overcome a lot of that, for sure. Also, with the monetizing installment sale, the other difference there is that for estate planning, for an estate, if you end up with an installment sale note from a dealer, and the estate's trying to unravel their estate, that note is going to be discounted for estate tax purposes. And I've seen discounts 35 to 40%. So it can help bring down the estate value for tax purposes. Now, both of these strategies are important. They're good depending upon the circumstances. And I think that's really the gist of our conversation today. And the fact of the matter is that everybody's transaction is unique. They all have their different circumstances. And so it's very important for a seller who is probably selling one of their major assets to do some advanced planning, get a roadmap out there, what they want to do. Because if you don't do that, you're liable to either buy a property you really don't want, or pay a tax that will cost you years of price appreciation. So for that, I'm going to pass it back for Raul for some closing remarks, then we'll open up for any questions that might be there. Raul?
Thank you, John. So to kind of follow up what John said, it's very important that the most important thing here is that every seller is different, has their own unique circumstance, and it's very important that the seller know what's right for him or her. John just talked about the differences between a monetized installment sale and a like-kind exchange, and it depends on the individual's particular circumstance that will determine whether we use one or the other. And it's also important to understand that we did a broad overview. The devil is always in the details in tax. It's somewhere in those 74,000 pages that John talked about earlier. For example, I just finished setting up a qualified opportunity fund. Just for the statute for the fund that governs the provisions for how to set up a fund, it's 544 pages. So it's important to understand that we gave you a broad overview, but it's very important to do your due diligence and get an advisor, someone to help you to kind of hammer out the details. And can we go to the next slide, please? So, I started off by saying, is a tax code our enemy or is it our friend? It all depends on when you engage it and whom you have by your side. As we discussed today, there are very good benefits in the code if they're used properly and they apply to your circumstance. I like this phrase by John F. Kennedy, which I have it framed in my office. It's the time to repair the roof is when the sun is shining. Coming from the government, I always get clients that are in the trouble with the government because they didn't plan correctly. So one thing I love about helping clients plan is to avoid the letter from the government. And by and all that entails is doing advanced planning, like John said, plan. And it really does alleviate a lot of the problems. So with that, we're gonna go to, if there's any questions.
All right, good morning, or sorry, I guess, yep, still good morning. I'm going to go ahead and walk through some of these questions that have been brought through. One question to Raul, this was emailed earlier. If a individual owns a property, primary residence, this is about the 121 exemption, if they own their home and get married and then within 6 months or so sell, do they get the 250 or the 500 as being married with the exemption?
So good question. Thank you, Patrick. So under the regulations, under section 121, there are various requirements. Based on the question, and it seems that the question is if either spouse meets what's called the ownership test, then it's okay to get the $500,000. However, there are other requirements that also must be met in addition to that. So, I mean, I can answer more in detail with an email, but that is, if the question is whether someone who was recently married, that in itself does not prohibit the $500,000 exclusion, but there are other tests that must be met as well.
Excellent. Thank you, Raul, for that. And we can respond to that question offline as well and make sure they get the specifics. This question is to Jon. It's kind of a two-part question. It says, can you share with us name of reputable installment sale dealers, and do we need to contact the lender, or how do we follow up with that?
Well, the company that I sit on the board of directors for, Escrow Collateral Corp, is a dealer. There are other dealers. You probably look them up online. The lender that we have a credit relationship is also something that you can contact the company for as well. But I hope does that answer your question? We are just like an exchange accommodator. There are a number of them out there, I'm guessing. I don't pay attention to that too much because it's my business. But yeah, if they are interested in more of that, just give me a call, no problem.
Okay, so just to sum up that, answer this question, he could reach out to you and have a conversation about that and who the lender is. Next question is back to Jon. How many of these types of transactions have you done or has your company done in the Bay Area? And does it go through just a normal escrow process, or are there special circumstances to set it up?
Yeah, so the company has been doing a installment sale transaction since 2005. It started out in 1984, actually. But in 2005, we started that. We started the monetizing installment sale. It took us a couple of years to get a credit relationship with a lender we liked that would give us 95% loan to value and at a very reasonable cost. And that started in 2011. So since then we've done, and it's a private company, so I can't share all the numbers, but we've done a lot of them. We have a lot of transactional experience because of that. And all different sites, not only with real estate, and this is the Bay Area, it's mostly, California is a big state where we have our tax is the largest, is highest in the nation. So we've done a lot of transactions in California, not only in like single family homes, commercial property mostly, businesses, veterinary practices, doctors' offices, done a lot of those, tax service projects. I remember a tax service company. We've done a lot of transactions, and most of them are in California, and a good percentage of those are in the Bay Area, all the way out through Sacramento. So it's a national company because and we're based out of Idaho for tax reasons. And so we do national sales all over the country, but mostly in California because of the tax rate.
Thanks, Jon. Okay, this question for Raul. How long does an individual need to be on title to claim the additional $250K free gain? This is almost a secondary question to the one that was already asked. In California, do they need to claim it as their primary residence for 2 of the last 5 years?
Right. So the first question talked about what's called the ownership test. And the ownership test is satisfied as if either of the spouses own the property. However, with this question now is going to the use test. How long has the person, they lived in the property? And yes, that has to be the 2 out of the last 5 years.
Excellent. John, the second part of the question that was asked in regards to number of transactions was the title company connection. So is there any specifics that need to be set up for title companies to close these deals?
No, the transaction is identical to an exchange. And so there's no particular qualification there. Any title company we can work with.
Great. Any other questions? Got about 5 minutes left in our presentation. You have
Just one thing, Patrick, because I forgot, I think I might have forgot to mention this. So what kind of like, when we talk about advisors and having an advisor walk you through this, what I and my firm do is we actually help sellers. Like I said, the devil's in the details. There's a lot of contracts to review. There are the agreements that to effectuate all of this, and that's something that an advisor would help you with, is determining whether or not the transaction, the specific requirements in a, let's say, a monetized installment sale are being followed through closing and thereafter. So that's, just forgot to mention that.
Okay. Thank you for those details. We have a question on flippers, rehabbers, developers. May they get the same tax treatment as an ordinary seller who is using the monetized installment sale?
You want me to answer that?
Well, I'll say one thing about developers. One thing that I said earlier about the installment sales, there's 2 exceptions. One of them is inventory. And this, in the government, this is an issue that comes up with flippers, is whether or not the developer is selling a capital asset, or are they selling homes in their course of business, i.e. inventory. So it's a deeper dive for the, to determine whether or not that the seller is in the business of selling homes, or, or it's a little bit probably clear in the flipper context, but John can speak more to that. But on the developer side, the installment sale rules do not apply, do not help a developer.
Right, and that question comes up periodically, particularly condominium developers. And condominium developers are really, they're buying a property to spin it. They fix it up and they sell it. They are dealers, essentially. However, there are ways, and this is a discussion offline with perhaps Raul, there are ways to set up a company so that you can qualify for an installment sale. But the general, if it's just a one-on, one-off situation where somebody buys a property, they're going to flip it and resell it, well, they're considered a dealer. So it doesn't qualify for an installment sale. But there are ways, if you set it up, again, it's the idea of the roadmap, planning it out in advance. It's possible, yes.
Thank you. Raul, back to the 121 exemption.
Mm-hmm.
Assuming that 2 out of the 5 years occupancy test is met, does the spouse need to be on title to receive the 250?
Right. So as I said earlier, so there's 2 tests. For the ownership test, either spouse. So, but they're married, correct? So it's either spouse meets the ownership test, but both spouses need to live there for the duration of the time required by the use test, which is 2 years.
Got it. All right. This question is for the monetized installment sale. The lender, do they provide the seller with the entire purchase amount, and the seller pays back the loan 30 years and the loan is interest only, or is it the proceeds or the equity that they're lending out?
So the lender will lend 95% of the value of the installment sale note. And at the end of when the loan is due in 30 years, the dealer will pay that amount to the buyer, seller, excuse me, the seller, and the seller will then pay that and pay off that loan. So there's no money out of pocket at the end of it. The beginning part, the lender will lend, again, 95% of the value of the installment sale note in cash. And at that point, the seller may have to pay off a loan. So out of those proceeds, they may have to pay off a loan they've already had. That's a third-party note on, say, a property. So yes, I mean, you essentially get the same amount of cash you would otherwise after paying off your loan, but deferring the tax.
So it's not the purchase price, it's the proceeds.
The proceeds, the net sales proceeds.
Okay. Reed asks, so the company Escrow Collateral Corp is an intermediary, a disinterested third party?
Yes, Escrow Collateral is a buyer, unrelated third party. It sits on the other side of the table from the seller, and they don't offer tax advice or investment advice. They're not related to the lender. They're just an intermediate party. That's what is a qualified intermediary for tax purposes in a 1031 exchange. Same thing applies. They've got to be a unrelated party to either the seller or the buyer in any shape or form.
All right, question from Vivian. How early do you have to decide to do a monetized installment sale? If you cannot find a replacement property in a 1031 exchange, can you switch to an installment sale?
So that question is interesting, and I think I'm going to ask Raul also to chime into this. Mm-hmm. But California, well, I tell you what, actually, that's an interesting story. We are under the opinion that you can do this. And there seems to be some pushback now because of a certain tax auditor who came out with a memorandum. Maybe, Raul, you can tell that story. It's one of your buddies, I think, right?
Yeah, so I was answering a question. So can you repeat that really quick?
Yes, I'll ask the question again. So this is from Vivian. How early do you have to decide to do a monetized installment sale? If you cannot find a replacement property in a 1031 exchange, can you switch to an installment sale? And John was asking about the franchise tax board.
Yes, so John and I have dealt with this issue at least a couple of times. One of the things, so the monetized installment sale is actually a perfect example of how the interplay between a like-kind exchange and an installment sale work. It's in the law that allows that a failed 1031 exchange can be converted into a 453 installment sale. But one of the things is because, like I said, the franchise tax board is very aggressive. It's very important that you contact an advisor as soon as possible when the seller's considering doing any kind of sale, right? Because that way, what our firm does, we start planning with a seller from day one into like looking at the documents and looking at what the potential audit risks might be in conducting not just a monetized installment sale, but a 1031 transaction or any kind of sale. So the time constraints are, but then also, correct me if I'm wrong, John, but there's also a time that the intermediary, the dealer, also needs a little bit of time to whip up the documentation, correct?
Yes. Well, practically speaking, it seems like there's two questions here. One question is when to talk to somebody about doing a monetizing installment sale, and the other question would be, can you use this as a backup to an exchange in case you can't find your upleg property?
Yes.
The first question is, well, as much time as you can. I tell everybody 2 weeks, if you're going to do a monetizing install, you decide you're going to do a monetizing installment sale, let's set it up for 2 weeks because we want everybody, the advisors, everybody to feel comfortable with the documents, etc. So 2 weeks before that. In terms of a backup to the exchange, now this is California. Anywhere else out of California, no problem. Yes, you can you can use this as a backup to an exchange, providing the accommodator is accommodating. In California, there was a memorandum that said if the exchange fails, then you have to withhold the 3 1/3% withholding tax. However, that's a very loose description, and at least the attorneys that I at Raul take it as like, well, wait a minute. If it's failed, that means you've exceeded your 45 days or your 180 days. Others seem to say that if you just decide not to do the exchange, that's failing. So Raul, that's a discussion that will probably go on forever, but maybe you can comment on that.
Right, yeah, so yeah, going specifically to that question, and the reason why I say that it's very important to talk to an advisor immediately is because one of the things I do with my clients, and our firm does with our clients, is we look at all the possible outcomes of the sale. We look at if someone wants to go into a 1031, we discuss with a client whether or not, if something goes wrong, is there a backup? But see, because of some of the recent government guidance that's come out, especially from the Franchise Tax Board, there are ways to address those issues. But the only way to do that is if when we start discussing with the client, the sale in of itself. And then so we can prepare the client that if, for example, let's say a 1031 doesn't qualify, we already have everything set up to go into the monetized installment sale in a way that would not, that would still meet the requirements of, say, the Franchise Tax Board. So the question is, it's basically, we address those issues at the very beginning, the what ifs, so to speak.
All right, so that really wraps up our questions that have been posted today. I want to thank both Jon Vicars and Raul Escatel for taking time out of their busy schedules to conduct this Q&A and webinar. And thank you all participants for joining on the call. Again, this will be recorded and available to view on Monday in the SFAR Social Library. Take care and have a great weekend.